The U.S. housing market is a complex and evolving environment, shaped by a variety of economic forces and regional dynamics. In 2024, it's crucial to identify which markets are best positioned to remain resilient in the face of potential economic turbulence. This guide delves into the top 20 housing markets that are less likely to experience significant downturns in the coming year. By examining key factors such as interest rates, construction costs, population trends, and infrastructure, we can better understand the elements that contribute to market stability and identify where opportunities might lie. Key factors influencing market stability. To assess the resilience of different housing markets, it's important to consider several critical factors that influence both supply and demand dynamics. These factors can vary significantly from one region to another, and understanding their impact is essential for making informed investment decisions. Interest rates and cost of capital. Interest rates have a profound effect on the housing market, directly influencing the cost of borrowing and, by extension, the affordability of homes. In 2024, mortgage rates are expected to remain higher than pre-pandemic levels, which could temper demand in some regions, particularly among first-time buyers. However, markets with strong economic fundamentals, where employment is robust and incomes are rising, may be better able to absorb these higher costs. In these areas, demand for housing can remain steady, even in the face of increased financing costs, as buyers prioritize proximity to employment centers and quality of life. Construction and renovation costs. The cost of building and renovating homes has risen significantly, driven by higher prices for materials and labor. This increase in costs can impact the availability of new housing and the profitability of real estate investments. Markets with constrained supply, where new construction is limited, may see prices remain stable or even rise as existing homes become more valuable due to their scarcity. On the other hand, regions with an oversupply of new housing might face downward pressure on prices as developers seek to sell off inventory. It's essential to understand the balance between supply and demand in each market to gauge its resilience. Land and property taxes. Variations in land costs and property taxes across different regions can significantly affect the overall cost of home ownership and, consequently, housing demand. High property taxes can deter potential buyers, particularly in regions where other costs of living are also elevated. Conversely, markets with more favorable tax environments may attract both residents and investors, supporting continued demand. It's not just the tax rate itself, but also how these costs interact with other economic factors, such as wages and job availability, that determines their impact on housing market stability. Population growth and job opportunities. Demographic trends are a key driver of housing demand. Regions experiencing strong population growth, often fueled by job creation in sectors like technology, healthcare, and education, are likely to see continued demand for housing. However, it's important to note that population growth alone does not guarantee market stability. The quality and stability of job opportunities, as well as the affordability of housing relative to incomes, play critical roles in determining whether a market can withstand economic challenges. Areas that balance these factors effectively are more likely to remain stable in the long term. Infrastructure and transportation. The availability and quality of infrastructure, including transportation networks, significantly influence a region's desirability and, by extension, its housing market stability. Markets with well-developed infrastructure can better support population growth and economic expansion, making them more resilient in the face of economic downturns. Additionally, regions investing in new infrastructure projects may see increased demand as accessibility improves. It's not just about the current state of infrastructure, but also about future development plans that can enhance a market's long-term appeal. Supply and demand dynamics. Supply and demand are fundamental drivers of housing market stability. When the supply of homes exceeds demand, prices tend to fall, as recently trending in markets with oversupply of new construction. Conversely, when demand outstrips supply, as occurred during the pandemic when many people relocated, prices can skyrocket. Markets with balanced supply and demand are generally more stable, while those experiencing either significant oversupply or severe shortages are more vulnerable to price volatility. It's crucial to monitor these dynamics closely, as shifts in supply or demand can quickly alter the stability of a market. Economic diversification. The diversity of a region's economy plays a significant role in its housing market's resilience. Markets heavily reliant on a single industry are more susceptible to economic downturns, which can lead to job losses and reduced demand for housing. On the other hand, regions with a diverse economic base, where multiple industries contribute to employment and economic activity, are typically more stable. Economic diversification helps cushion the impact of sector-specific downturns, supporting steady demand for housing, even when certain industries face challenges. Government policies and incentives. Local and national government policies, including zoning laws, tax incentives, and housing subsidies, can influence market stability. For example, restrictive zoning laws can limit new construction, exacerbating supply shortages and driving up prices. Conversely, tax incentives for home buyers or developers can stimulate demand or increase the housing supply, affecting market dynamics. Understanding how government policies might change or be implemented in a specific region can provide insights into the potential for market shifts. By considering these factors in a nuanced and regional context, investors can better understand the dynamics at play in different markets and make more informed decisions. It's important to recognize that while certain regions may exhibit strength in one area, they may face challenges in another. The goal is to identify markets where the overall balance of these factors supports long-term stability and growth. We have selected 20 cities and regions that present promising opportunities for real estate investment in 2024. Each of these markets has been evaluated based on economic resilience, population trends, supply and demand dynamics, and potential for rental yields and property appreciation. Please note they are not ranked in a specific order. 1. Raleigh, North Carolina. Rationale. Raleigh continues to be a strong market for real estate investment, driven by the growth of the Research Triangle, a major hub for technology, healthcare, and education. The city's population has been steadily increasing, with demand for housing outpacing supply, leading to price appreciation. Rental yields are attractive due to the influx of young professionals and students, and the city's diverse economy supports long-term stability. With ongoing development and infrastructure projects, Raleigh presents strong potential for both cash flow and property appreciation. Cautionary notes. Watch for potential oversupply in suburban areas, especially where new developments are concentrated. Focusing on properties near job centers and universities may offer better long-term returns. 2. Pittsburgh, PA. Rationale. Pittsburgh's transformation from an industrial city to a hub for technology, healthcare, and education has stabilized its real estate market. The city offers affordable entry points for investors, with rental demand driven by a large student population and healthcare professionals. Property values have been appreciating, though at a slower, more sustainable pace compared to some other markets. Pittsburgh's relatively low cost of living and ongoing urban revitalization projects contribute to its attractiveness for long-term investment. Cautionary notes. Investors should carefully evaluate neighborhoods, as some areas still face economic challenges. Focus on neighborhoods benefiting from revitalization efforts and those near major employers. 3. Columbus, Ohio. Rationale. Columbus is experiencing robust economic growth, supported by a diversified economy that includes education, government, and technology centers. The city's real estate market is characterized by steady appreciation and strong rental demand, particularly in areas near Ohio State University and downtown. The influx of young professionals and students creates a reliable tenant base, while property values continue to rise. Columbus also offers favorable conditions for cash flow properties, with competitive rental yields and relatively low property taxes. Cautionary notes. Investors should monitor supply levels in newly developed areas, though overall, the market remains balanced and favorable for long-term investment. 4. Salt Lake City, Utah. Rationale. Salt Lake City is a growing market with a strong job sector in technology, outdoor recreation, and healthcare. The city's population growth is driving demand for both rental properties and home purchases, leading to steady price appreciation. Rental yields are solid, supported by a growing workforce and a stable economy. Salt Lake City's limited housing supply relative to demand helps maintain property values, making it an attractive market for investors seeking both cash flow and equity growth. Cautionary notes. Rising home prices may impact affordability, so investors should target areas with strong rental demand to ensure consistent returns. 5. Charlotte, North Carolina. Rationale. Charlotte is a rapidly growing financial hub with a strong economy bolstered by banking, energy, and tech sectors. The city's expanding population and job market are driving demand for housing, with rental properties offering solid yields. Charlotte's real estate market is characterized by consistent property appreciation, supported by a stable economic foundation and ongoing infrastructure development. For investors, Charlotte presents opportunities for both cash flow and long-term equity growth, particularly in emerging neighborhoods and those near employment centers. Cautionary notes. Be cautious of rising crime rates in certain neighborhoods. Focus on areas with ongoing development and high demand. 6. Indianapolis, Indiana. Rationale. Indianapolis offers a balanced real estate market with affordable property prices and steady demand. The city's economy is diverse, with strengths in healthcare, manufacturing, and education, supporting a growing population and consistent rental demand. Investors can expect competitive rental yields, especially in areas near major employers and universities. Indianapolis also benefits from relatively low property taxes, making it a favorable market for generating cash flow. Cautionary notes. Crime rates vary by neighborhood, so investors should focus on well-established, low-risk areas with strong economic activity. 7. Kansas City, Missouri. Rationale. Kansas City is a growing market with a diverse economy that includes healthcare, technology, and manufacturing. The city's real estate market is characterized by affordable entry points, steady appreciation, and strong rental demand. Investors can find attractive opportunities for both cash flow and equity growth, particularly in neighborhoods undergoing urban renewal. Kansas City's investment in infrastructure and its relatively low cost of living further enhance its appeal to real estate investors. Cautionary notes. Some neighborhoods may have higher crime rates. Focus on areas with active redevelopment projects or those near employment hubs. 8. Omaha, Nebraska. Rationale. Omaha's stable economy, driven by the finance, insurance, and healthcare sectors, supports a steady real estate market with moderate appreciation and strong rental demand. The city is known for its affordable housing market, making it an attractive option for investors seeking cash flow properties. Omaha's low unemployment rate and ongoing population growth contribute to a reliable tenant base, while property values continue to rise at a sustainable pace. Cautionary notes. Be cautious of potential oversupply in suburban areas, particularly where new developments are concentrated. 9. Madison, Wisconsin. Rationale. Madison's economy is anchored by the University of Wisconsin and a growing tech sector, driving consistent demand for housing. The city's real estate market benefits from limited housing supply relative to demand, resulting in steady property appreciation. Rental demand is strong, particularly from students and young professionals, making Madison an attractive market for investors seeking reliable cash flow and long-term equity growth. The city's commitment to sustainability and quality of life further supports its investment potential. Cautionary notes. Monitor affordability trends, particularly in high-demand neighborhoods, as rising prices could impact rental yields. 10. Huntsville, Alabama. Rationale. Huntsville is one of the fastest growing cities in Alabama, with an economy centered around aerospace, defense, and technology. The city's population growth and job creation are driving demand for housing, leading to steady price appreciation and strong rental yields. Huntsville offers affordable entry points for investors with opportunities for both cash flow and equity growth. The city's ongoing development projects and infrastructure improvements further enhance its investment appeal. Cautionary notes. Although Huntsville is generally considered a strong long-term investment, recent data suggests that the market is starting to experience some price softening, with notable price cuts in certain areas. Investors should be mindful of potential oversupply, particularly in newly developed neighborhoods. 11. Northeast region, Connecticut, New Jersey, New York. Rationale. The Northeast region, including Connecticut, New Jersey, and New York, offers a mix of stable real estate markets supported by strong job centers and high population density. Areas close to major cities like New York and Boston benefit from steady demand for rental properties, particularly in commuter towns. Property values in these areas tend to appreciate consistently, driven by limited housing supply and high demand. Investors can find opportunities for both cash flow and long-term growth, especially in areas undergoing urban revitalization or with strong job markets. Cautionary notes. High property taxes and regulatory challenges in some areas may impact profitability. Focus on regions with ongoing economic development and stable demand. 12. Manchester, New Hampshire. Rationale. Manchester offers real estate investors a stable market with affordable property prices and strong demand driven by its proximity to Boston. The city's economy is diversifying with growth in technology and service sectors. Investors can expect solid rental yields, particularly from professionals commuting to Boston, while property values continue to appreciate at a moderate pace. Manchester's low tax burden and high quality of life add to its attractiveness as a real estate investment market. Cautionary notes. Manchester is smaller and may have slower growth compared to larger markets, so investors should prioritize areas with higher demand and economic activity. 13. Portland, Maine. Rationale. Portland's real estate market is supported by a combination of steady demand, limited supply, and a growing economy. The city's rental market is particularly strong, driven by a mix of professionals, retirees, and tourists. Property values in Portland have been appreciating steadily, making it a solid market for both cash flow and long-term equity growth. The city's focus on sustainability and its thriving tech startup scene add to its investment potential. Cautionary notes. As a smaller market, Portland may have slower growth compared to larger cities. Investors should focus on high-demand areas near the downtown or waterfront. 14. Albany, New York. Rationale. Albany's real estate market benefits from its role as the capital of New York, with a stable job market centered around government, healthcare, and education. The city's affordability compared to other parts of the state, along with ongoing urban revitalization efforts, make it an attractive option for investors. Albany offers moderate rental yields with the potential for property appreciation, particularly in areas experiencing redevelopment. Cautionary notes. Albany's growth may be slower than in more dynamic markets, but its stability and low entry costs provide a solid foundation for long-term investment. 15. Burlington, Vermont. Rationale. Burlington offers a stable real estate market driven by steady demand, particularly from students and professionals associated with the University of Vermont. The city's limited housing supply relative to demand has supported property appreciation, while rental yields remain competitive. Burlington's commitment to sustainability and quality of life further enhances its appeal for long-term investment, especially in the multifamily and student housing sectors. Cautionary notes. Burlington's small size limits its growth potential compared to larger markets. Investors should focus on properties near the university or downtown areas where demand is strongest. 16. Cincinnati, Ohio. Rationale. Cincinnati's diversified economy, affordable housing market, and ongoing urban revitalization projects make it an attractive market for real estate investors. The city offers solid rental yields, particularly in areas near major employers and universities. Property values in Cincinnati have been appreciating steadily, supported by population growth and increased demand for housing. The city's commitment to redeveloping its downtown and surrounding neighborhoods provides opportunities for both cash flow and equity growth. Cautionary notes. Investors should be cautious of neighborhoods with higher crime rates and focus on areas benefiting from redevelopment efforts. 17. Grand Rapids, Michigan. Rationale. Grand Rapids is a growing market with a strong job sector in healthcare, education, and manufacturing. The city's real estate market benefits from steady demand, affordable property prices, and competitive rental yields. Grand Rapids has seen consistent property appreciation, driven by its growing population and ongoing urban development projects. The city's high quality of life and proximity to outdoor recreation further support its investment potential. Cautionary notes. Investors should monitor any areas with slower economic recovery or limited demand, though the overall market remains stable. 18. Spokane, Washington. Rationale. Spokane presents a compelling investment opportunity as an affordable alternative to Seattle, with a growing economy supported by healthcare, education, and manufacturing sectors. The city's real estate market has seen steady demand, leading to consistent property appreciation and solid rental yields. Spokane's proximity to outdoor amenities and its emerging cultural scene attract a diverse tenant base, making it a stable market for long-term investment. Cautionary notes. While Spokane is experiencing growth, it remains a smaller market compared to Seattle. Investors should focus on high-demand areas to maximize returns. 19. Sacramento, California. Rationale. Sacramento offers real estate investors a stable market with strong demand driven by its proximity to the Bay Area. The city provides a more affordable alternative for those seeking access to major job centers while maintaining steady property appreciation. Sacramento's diversified economy, with strengths in government, healthcare, and education, supports a growing population and reliable rental demand. The city's ongoing infrastructure improvements further enhance its investment potential. Cautionary notes. High state taxes and regulatory challenges could impact profitability. Investors should target well-established neighborhoods with strong demand. 20. Chattanooga, Tennessee. Rationale. Chattanooga's real estate market is supported by steady population growth, driven by its burgeoning tech sector and attractive quality of life. The city offers affordable property prices with strong rental yields, particularly in areas near downtown and major employers. Chattanooga's ongoing infrastructure and urban renewal projects provide opportunities for both cash flow and property appreciation. The city's strategic location and growing economy make it an appealing market for long-term investment. Cautionary notes. Chattanooga is smaller than some other markets, so growth may be more modest. Investors should prioritize areas with ongoing development and higher demand. As investors consider the top regions for real estate investment, it's crucial to also be aware of certain markets currently exhibiting signs of vulnerability. In Florida, several regions are facing significant challenges. Tampa, Cape Coral, and Northport, Sarasota are all experiencing a rapid increase in inventory, with listings rising sharply year over year in some areas. This surge in supply is putting downward pressure on prices, particularly in overvalued zip codes, as fewer people are moving to Florida and more are leaving due to rising costs and demographic shifts. These factors suggest that the Florida housing market could be entering a multi-year downturn. Similarly, Texas is seeing distress in multiple key markets. Austin, once a pandemic boomtown, is now grappling with significant market correction, with inventory levels rising considerably and median listing prices showing noticeable declines. Dallas and San Antonio are also facing oversupply issues, with inventory levels reaching record highs, leading to substantial price cuts. In Dallas, a significant portion of sellers have reduced prices recently, especially in new developments, signaling a potential downturn. San Antonio, with a large number of homes on the market, is experiencing unprecedented supply levels, further depressing prices. In Arizona, Phoenix, a city that saw massive growth during the pandemic, is now witnessing a major increase in inventory, the highest seen in years. While prices remain relatively high, the growing supply is beginning to force corrections, and further declines could be imminent. Colorado is not immune either, with Denver showing signs of a market slowdown. The city has seen a noticeable drop in median listing prices year over year, coupled with a surge in inventory and price cuts, suggesting that the market may continue to weaken. Finally, Tennessee's Nashville, once a booming market, is now experiencing an inventory explosion, with homes for sale increasing dramatically over the past few years. This has led to significant price reductions as the market adjusts to the increased supply. Investors should approach these states with caution, keeping a close eye on inventory trends, price adjustments, and broader economic conditions. While some of these markets may still offer long-term potential, the current trends suggest that investors should proceed with caution and conduct thorough analysis before making any decisions. The U.S. housing market in 2024 is a landscape of contrasts, with each region experiencing its own set of challenges and opportunities. By focusing on markets with strong economic fundamentals, steady population growth, and manageable inventory levels, investors can better navigate the uncertainties of the coming year. The 20 markets outlined in this guide offer a combination of affordability, economic strength, and resilience, making them potentially safer bets for real estate investments in 2024. Understanding the dynamics at play, from interest rates and construction costs to population trends and infrastructure, is crucial for making informed investment decisions. Whether you're a seasoned investor or just starting, focusing on markets with strong fundamentals will help you build wealth and weather economic storms that may come. Stay informed, stay cautious, and focus on the regions that demonstrate long-term stability. By doing so, you can position yourself to not only survive but thrive in the 2024 real estate market and beyond, becoming a Realty Rockstar. Share and subscribe.